Hello and welcome back to the podcast. Today we are diving into one of the hottest and most urgent topics in estate planning and taxation: SARS intensified crackdown on trusts. Whether you're a trustee, a beneficiary, or a professional advisor working with trusts, this is a conversation you cannot afford to miss. The reality is that SARS is ramping up compliance enforcement, and if you're not paying attention, the consequences could be severe, not only for the trust itself, but personally for the trustees involved. So let's explore what's happening, why SARS is turning up the heat, and what risks trustees are facing, and what practical steps you can take to stay compliant. What's going on? SARS has identified that roughly 60% of registered trusts have not been registered with SARS. Think about that for a second. More than half of South Africa's trusts are flying under the radar, at least from a tax perspective. This is a massive compliance gap, and SARS is determined to close it. Why does this matter? Because trusts are often used to hold significant wealth, properties, businesses, and investment portfolios. And where there's wealth, there's tax revenue at stake. From SARS' perspective, tightening the net around trusts is not only fair, but also necessary to protect the tax base. Let's look at the consequences of non-compliance. So let's talk about what happens if the trust is not compliant. Failure to register or file the required return exposes the trustees to administrative penalties, which can be imposed monthly until the trust is compliant, back taxes, plus interest. SARS can go back several years to collect unpaid amounts, and in extreme cases, personal liability for trustees. That's right, trustees can be held personally accountable for a trust tax defaults. Let's put this into context. Imagine a family trust holding rental property worth 5 million. The trustees fail to file the annual tax return for 3 years. SARS could not only demand the unpaid taxes but also impose penalties of up to 250,000 plus interest. That's a financial hit that could derail the entire purpose of having the trust in the first place. So here are some key compliance requirements. So what exactly does SARS expect? Let's break it down. Trust registration with SARS. This is a separate from the registration with the Master of the High Court. Many trustees assume that once they've registered with the Master, they are covered. Not so. You must also register with SARS. Annual filing of tax returns. Trusts must submit ITR12T as well as IT3T certificates for any distributions made from the trust to the beneficiaries of the trust. Accurate record keeping. Trustees need to maintain up-to-date trust deeds, minutes of trustee meetings, and detailed records of all income and expenditure. Here is an example. If a trust distributes 100,000 to a beneficiary without submitting the required IT3T certificate, SARS can assess additional tax and impose possible penalties. It's not enough to simply record the distribution internally. The reporting must be done correctly and on time. Folks, please be wary of this. Practical steps for the trustees. Now, this might all sound overwhelming, but there are ways trustees can manage their risks. Here are some practical tips. Conduct annual internal audits. Even a simple year-end compliance review can catch issues before SARS does. Use trust-specific accounting software. This helps track income, expenses, and distributions in a way that meets SARS expectations. Educate all trustees. Every trustee has legal duties. If you are sitting on a trust board, you need to know what your responsibilities are. Ignorance is not an excuse. Create a compliance checklist. Something as simple as a quarterly reporting checklist can prevent missed filings and costly mistakes. The key message here is that trustees must be proactive. Compliance is not optional, it's critical. So here are some final thoughts. SARS crackdown on trusts might feel intimidating, but it does not need to be. With the proper systems, professional support, and a proactive approach, you can protect yourself and your beneficiaries. Remember, the whole point of a trust is to safeguard assets, provide for loved ones, and create long-term stability. Don't let poor compliance jeopardize these goals. So, if you are a trustee, take this as your wake-up call. Review your compliance status, get the records in order, and consult with your accountant or tax advisor. By staying ahead of SARS, you will not only avoid the penalties, but also preserve the integrity and the purpose of your trust. That's it for today, folks. If you found this useful, share it with other trustees, business owners, or family members involved in trusts. And as always, remember, good governance and compliance aren't just tick boxes. They are the foundation of protecting wealth for generations to come. Thanks for listening, and catch you in the next episode. Please like, share, and subscribe. Until next time, this is Vidyant Bola for the VHA podcast. Cheers.